Breaking news out of Wall Street tonight, and if you own Nvidia stock, you need to hear this right now. Once the undisputed king of the artificial intelligence chip revolution, Nvidia has quietly transformed into something nobody predicted just a few months ago, a chip stock loser. And according to a bombshell analysis from Barron's, this stunning reversal might not just be a temporary blip. This could be the new reality for a company that Wall Street treated like an untouchable god. Let's break this down fast, because the numbers here are shocking. Nvidia, the company that became synonymous with the AI boom, that delivered returns so extraordinary it made ordinary investors feel like geniuses, is now underperforming its chip sector peers. The stock that seemed to only know one direction straight up is now grinding sideways and drifting lower, while other semiconductor players are finding their footing and moving ahead. So what happened? How does the most celebrated chip company on the planet fall behind? Several critical forces are converging all at once, and together they are creating a perfect storm around Nvidia's stock performance. First, valuation reality is finally catching up. For months, Nvidia traded at price-to-earnings multiples that required nothing short of miraculous, perpetual growth to justify. When you price a stock for perfection, any sign of imperfection sends investors heading for the exits. And those signs are starting to emerge with increasing frequency. Second, competition is no longer a distant threat, it has arrived. AMD is pushing harder than ever with its AI chip offerings. Intel is restructuring and fighting back. And perhaps most critically, the hyperscale cloud giants, we're talking Amazon, Google, and Microsoft, are aggressively developing their own custom silicon in-house. Every chip those companies build themselves is a chip they are not buying from Nvidia. That equation is deeply troubling for Nvidia's long-term revenue trajectory. Third, there is a growing question about demand sustainability. The initial frenzy of AI infrastructure spending was historic, unprecedented, and frankly, almost irrational in its intensity. Data centers were racing to stockpile Nvidia's H100 and Blackwell chips as fast as humanly possible. But that panic buying phase is moderating. Enterprise customers are pausing, auditing their AI investments, and asking harder questions about actual returns. When the feeding frenzy slows, companies priced for feeding frenzy growth suffer the most painful corrections. Fourth, export restrictions are biting harder than many analysts initially anticipated. The United States government's curbs on selling advanced chips to China represent a significant and permanent reduction in Nvidia's addressable market. China was not just a market, it was a massive, high-margin, rapidly growing market. Losing meaningful access there is not something Nvidia can simply shrug off or replace overnight. And here is the angle that Barron's is pressing hardest, the one that should genuinely concern long-term investors. The structural argument that made Nvidia bulletproof, that its CUDA software ecosystem created an unbreakable moat, is facing its most serious challenge yet. As alternative frameworks mature and competitors invest billions in developer tools and ecosystems, that moat is looking slightly less permanent than the bulls always insisted. Now, none of this means Nvidia is a broken company. The technology is still extraordinary. The talent is still world-class. The revenue numbers are still, by almost any historical standard, remarkable. But remarkable revenue and remarkable stock performance are two very different things when expectations have been priced to perfection. The brutal truth about stock markets is that being great is simply not enough. You have to be great and surprising. And right now, Nvidia is struggling to deliver those surprises to the upside. The question every investor needs to sit with tonight is this: when a stock built entirely on the promise of limitless future growth starts running out of room to surprise, how long before the market decides that the future arrived earlier than expected and already got priced in?